Hey everyone, welcome back to the channel. If you've been glued to financial headlines lately, you've probably heard all the chatter about the infamous September slump. History, they say, usually paints September as the worst month for stocks. But guess what? This year, the market is throwing us a curveball, defying expectations and hitting record highs. So what's really going on? Are we about to see history rhyme, or is this time truly different? Stick around because we're breaking down why this market just keeps soaring and what it means for your money. Let's dive right into what's been on everyone's mind, the September effect. Traditionally, stocks tend to be weaker in September compared to other months. Over the last decade, September has seen stocks finish down by about 2% on average. If you go all the way back to 1950, it's still down around 0.8%. Pretty consistent, right? But here's the twist this year. The market has a ton of positive energy. Many experts believe that a major interest rate cut, which is pretty much guaranteed to happen around September 17th, will actually push stocks higher by the end of the month. That would be a truly unusual finish for September. You see, sometimes these historical patterns become a bit of a self-fulfilling prophecy. Investors expect a September dip, and that expectation can influence their actions. But 2024 has been one of the wildest years in market history. We've seen a lot of back and forth between the Federal Reserve and the White House. We've got ongoing tariffs, and then this widely expected rate cut just around the corner. All this unusual activity makes traditional seasonality trends less reliable. Take the old saying, sell in May and go away. That didn't work out this year at all. So don't let history scare you too much right now. Now, let's talk about the Federal Reserve because they're a huge part of this story. Many feel that the Fed has been a bit slow to react with its policy changes. For instance, the jobs report recently confirmed that they've been dragging their feet. And get this, we even learned that one of the months, a few months back, maybe June, actually turned negative when they revised the numbers. If that had been known earlier, we probably would have seen a rate cut already. This raises the question, is the Fed too late? It's a tough spot for them, honestly. The Fed is essentially a backward-looking institution, always analyzing past data. But the market and the economy move at lightning speed, changing faster than we can imagine. Plus, the data they work with, especially from places like the Bureau of Labor Statistics, can be tricky. It often gets revised, and since the pandemic, people just haven't been responding to government surveys as much, making the data less reliable with a bigger margin of error. So it's not necessarily about anyone at the Fed doing a bad job, it's more about the outdated methods being used to track all this rapidly changing information. Despite these challenges, the market overall is showing incredible strength. The S&P 500 is actually having a better than average year, and even a better than average year for a post-election period like this one. Remember all those tariff doomers at the start of the year predicting the market would crash, or the worries about the Fed's independence? Investors pretty much ignored all that. It's been a story of betting against the bears. Those loud, cautious voices in the first half of the year ended up being wrong as the bulls pushed forward. But there are some interesting things happening beneath the surface, especially when we look at market concentration. We're seeing a high concentration of market gains coming from just a few big companies, almost at levels we saw during the dot-com bubble. That comparison usually makes investors nervous. However, there's a key difference today. The companies at the very top, like the Magnificent Seven, are incredibly profitable with huge balance sheets. Their earnings have largely justified their high valuations, providing a cushion to that concentration argument. While these mega companies might see their growth slow a bit, other S&P 500 companies are expected to catch up in earnings. And what about everyday Americans? It feels like a tale of two economies. If you've been invested in the market, you've likely done very well. But if you haven't, your dollar has lost significant purchasing power. Since 2020, we've probably lost about 25 or even 28% of a dollar's value. That's huge. This really underscores the importance of investing to keep up with inflation, but it also highlights a widening gap in wealth. This brings us to a really fascinating trend, the consumer. You might expect big tech stocks to be crushing it, but guess what? Dollar General and Dollar Tree are actually outperforming most of the retailers and even a tech giant like Nvidia this year. When you look at their performance charts, it's shocking. The CEO of Dollar Tree even mentioned that the majority of their new customers last quarter were households earning six figures. That's right. High-income earners are now shopping at dollar stores. This points to a clear flight to value. Everyone, regardless of income, is trying to stretch their dollars further because of lost purchasing power, persistent inflation, and higher interest rates. It definitely suggests a consumer who feels financially constrained. Speaking of stretching dollars and hedging against inflation, let's talk about gold and Bitcoin. Gold is currently hitting record highs, and a big reason for this is that many governments and central banks around the world, like China and Russia, are buying it up. Retail investors are also jumping on the gold train, and there's a general belief that it's a good way to protect yourself against the dollar losing its value. Bitcoin has also had a very strong year, seeing similar interest. We're even seeing companies now, not just individuals, putting Bitcoin and other crypto assets on their balance sheets. Companies like MicroStrategy are making a big bet that the dollar will continue to lose value and Bitcoin will continue to grow over time. So they're choosing to hold an asset they believe will appreciate instead of one that might get debased. While this trend could signal some froth or overexcitement in the market, for now, it seems to be continuing. Finally, let's consider the classic showdown: mega cap moats versus small cap scramble. Mega cap companies are like the armor-plated giants of the market. They have huge balance sheets, strong profit margins, and they can buy their own stock. When things get tough, they usually tighten their belts and keep the cash flowing, suffering less than smaller companies. On the other hand, small-cap companies are more sensitive to the economy and interest rates. When the economy speeds up and money gets cheaper, these small caps can really take off. So who wins this battle in the coming months? If we see 2 or 3 interest rate cuts this year, small-cap stocks are expected to do very, very well because they are so sensitive to interest rates. Mega caps, while strong, might be a bit overextended, despite their fantastic earnings. But if we only get one rate cut or if cuts are delayed, then mega caps might be the safer bet. Our prediction is that we'll likely see about 3 rate cuts by the end of the year. The Fed seems willing to let inflation run a little hotter right now, focusing more on the labor market, and let's not forget political pressure is definitely a factor in their decisions. The biggest takeaway for all of us is this: in a market as wild and confusing as this one, with so many conflicting signals, it's crucial for investors to keep a cool head. Don't panic sell every time a scary headline hits. For those with a long-term investment horizon, like 30 years or more, the day-to-day market swings, tariff scares, or Fed worries are intense in the moment, but your portfolio will likely be just fine if you stick to your plan and keep investing consistently. That's all for today. We've covered everything from the September effect to the surprising strength of dollar stores. I hope this helped you cut through some of the market noise. If you found this useful, please hit that like button, subscribe to the channel for more market insights, and click the bell so you don't miss our next episode. Thanks for watching, and we'll see you next time.